Gentlemen, and thank you for joining us for today's webinar, Alternative Funding for the Midlands, Unlocking Your Working Capital. We are just going to give it a couple of minutes just for people to join the call today, so hopefully we won't keep you too long. But just to let you know a little bit about the British Business Bank, we are the government's economic bank here in the UK, and we bring expertise and capital to the smaller business finance market. So we are here to help those small businesses with their growth. As I say, we're just going to give it a couple of minutes just for anybody to join us before we start with today's event. And once again, thank you for joining us today for Alternative Funding for the Midlands webinar, Unlocking Your Working Capital. As I say, this is held with the British Business Bank as part of our Business Finance Week this week. There are other events happening as well the rest of this week, so please check those out on our website. We're just going to give it one more minute before we start. So good morning and thank you for joining us for the Alternative Funding for the Midlands Unlocking Your Working Capital webinar today, hosted by the British Business Bank. Just to let you know that we will be recording this session so that it can be shared later on. Just going to give it another minute or so just for people to be able to join the call, and then we will get started and get the event opened and run through. So thank you again for joining us for the Alternative Funding for the Midlands Unlocking Your Working Capital webinar, hosted today by the British Business Bank, with a number of guest speakers that will be coming up. We are 2 minutes past 10, so I am keen to get started, conscious that we don't want to be keeping you guys later than already planned. So first of all, I would like to hand over to Warren Rawls, Managing Director for the UK network at the British Business Bank. Warren, if you'd like to join me on screen, that'd be great.
You should be seeing me now, Tracy. Can you
Lovely.
see me? Can you hear me?
Excellent. I can. Thanks, Warren.
Thank you very much. Thank you, everyone, for joining us for this online webinar as part of this year's Business Finance Week. This is the second year that Business Finance Week has taken place. Last year's pilot grew from an initial idea of a small collection of themed events into a campaign with more than 60 partners, reaching thousands of businesses across the UK. This year, today's event is one of 27 taking place across the UK, 16 of which happen in person and 11 are online. I'm delighted to be here to open today's event, Alternative Funding for the Midlands, Unlocking Your Working Capital, as part of today's theme, Thriving with Finance, Unlocking Your Working Capital. This event is also the second of 3 webinars planned in the series, Alternative Funding for the Midlands. As Tracy said, my name is Warren Rawls. I'm the Managing Director of the UK Network team at the British Business Bank, a government-owned but independently managed economic development bank. The British Business Bank is committed to breaking down the disparities in access to finance for smaller businesses across the UK's nations and regions. And Business Finance Week brings a great opportunity to work collaboratively across the business support community, so we can really help smaller businesses find out more about the range of finance options that can make a difference to them. Businesses who attended last year told us that they felt better informed about the finance options available, and 7 in 10 plan to find out more to access finance as a result of the week's activities. Businesses who provided us with feedback say that so far they've gone on to secure over £15 million in finance. We're aiming to build on that through today's event, which brings together a number of the bank's delivery partners and other individuals from across the Midlands finance ecosystem. In the last financial year, the British Business Bank continued to deploy the vast majority of our finance in its core schemes outside of the largest UK banks, exceeding the targets set for us by government. Our recent annual report and accounts show that 99% of the bank's finance was provided outside the main high street banks. I'm delighted to be supported in today's event by First Enterprise Loans, Simply Asset Finance, Close Brothers Invoice Finance, Central Business Finance, and Rivetwise Limited. And today's webinar will focus on exploring finance options for growth, such as cash flow lending, asset finance, and invoice finance. Access to finance is essential for any business looking to scale up and stay ahead of the competition, but too often smaller businesses struggle to secure the right type of financing they need. That's why it's important to explore all options available and work with finance providers who will understand your unique needs so that you can access the financing that's right for you, no matter where or who you are. If you're a smaller business or working with the region's businesses, over the next hour and a half, you will find out about what types of finance they offer and how they can support you. We'll also be discussing current issues in the Midlands lending market. This webinar has been recorded in full, and a recording will be made available through the bank's Business Finance Week webpage. I'm looking forward to hearing from all of our speakers today. Thank you for being here as part of Business Finance Week. Let's get started with the session, and I'll hand back to you, Tracy.
Thanks, Warren. And I would like to introduce our first speaker, which is Daniel from First Enterprise Loans. So Daniel, if you'd like to join me on screen, we can hand over to you for the first presentation.
Great, thank you, Tracy. Wonderful. Good morning, everyone. My name is Daniel Carrico. I am the Executive Director at First Enterprise. We are a Nottingham-based organisation providing funding for startups and existing businesses, starting from £500 up to £250,000. Next slide, please. This slide effectively provides you just with a general overview in terms of the amounts of funding that we have invested in the last year, just over £8 million. The vast majority of our funding goes to organisations that are based in deprived areas. So over 60% of our funding has gone to organisations based in those areas. About 36% of our overall funding has gone to female-led organisations, and around about 38% of our funding has gone to organisations that are run by the BAME-led communities. Next slide, please. In terms of an overview, in terms of the funding for First Enterprise, so we are partly funded from the British Business Bank through the Startup Loans Company. We also run the Midlands Engine Investment Fund, focusing on the East and Southeast Midlands region. And we have additional capital from Big Society Capital, and we have a little bit of our own funds allowing us to go and fund businesses outside of the East and Southeast Midlands region. Next slide, please. What I wanted to kind of start off with this slide is really give people an overview in terms of customer journeys from our experience. Typically, businesses would start off with going to the high street banks, so people like NatWest, HSBC, Barclays, and Lloyds with their loan application. Typically, if they are declined, if those banks aren't able to help, then they go through to challenger banks, organizations such as Metro or Unity Trust Bank or Oak North or Triodos. Those organizations seem to have a more flexible and open credit policy than high street banks. If clients aren't able to get funding from those banks, they then typically go to kind of the fintech or the online organizations. People like Atom Bank, Monzo, Tide, Starling Bank. Alternative providers also include Funding Circle, for example, Iowaka, ThinCats, or First Enterprise. First Enterprise are part of the Responsible Finance Network. And if you look at all of those those lines and those organizations, at the top, credit policies seem to be quite tight. And as you go down through those rows, we feel that credit policies become a little bit more flexible, a little bit more open to viable businesses, but for one reason or another have been declined by a couple of providers. Next slide, please. In terms of what underwriters expect to see, and this is very similar across all providers. So organizations typically have some type of application form, and then starts with the due diligence process. So business plans, cash flow forecasts, a breakdown of organizations' assets and liabilities, sales assumptions. Effectively, what organizations and underwriters are looking to understand is where have you come from? where are you now and what goals do you have in the future, and how are you going to service whatever debt that you are applying for. Next slide, please. In terms of kind of a loan application process, so from First Enterprises' point of view, we typically start off with some type of application form. We check to see if you are eligible in terms of the funds that we manage. We help our clients by providing some type of business advice in terms of their application, help organizations with their credit application, and really give them advice to say, look, we understand what our underwriters are looking for. These are the areas of your business plan or your assumptions or your forecasts that need a little bit of attention. And effectively then after that, and we go through to our credit underwriters, we come back with a loan decision of either accept or decline, and then signpost organizations to other providers. Next slide, please. This is a breakdown here of just my contact details. We have our website and direct telephone number. We'd be more than welcome to discuss any applications that people have, any requests for funding. Please feel free to reach out to me. I'm now going to pass over to Chris from Simply Finance.
Thanks, Daniel. It was very interesting. I appreciate everyone's time today. I want to start by introducing who Simply are. Let's see if you put the next slide, please, Tracy. So Simply, we started back in 2017. We aimed to try and become a bit of a disruptor in the marketplace, aiming for the SME market to support the SMEs that need funding for asset acquisition. These could be trucks, trailers, equipment, machines, that sort of thing. We do really pride ourselves in the speed and the quality of our lending decisions. We have really good technology, so we have apps for the customers to be able to download their documents, get settlement figures, that sort of thing. But we back that up very much with a national team of sales managers. We've got over 40 sales managers now around the country, of which we have 6 based in the Midlands, and over 150 staff in total across the company. Since 2017, we've actually lent over £1.3 billion in funding and supported over 6,400 businesses, and this is across all sorts of different sectors. We're very proud of the different awards that we've gained since we started. We've been recognised by the Financial Times for the last 2 years as one of the fastest growing companies in Europe, but we've also been recognised as an SME Fund of the Year, even right through to Employer of the Year, recognition for our technology and many different things. Next slide, please. So our offering, we offer, like I said earlier on, we cover a wide variety of sectors, listed off here: construction, recycling, transport, manufacturing, but that's including all forms of engineering, woodworking, plastics, print and packaging. Primarily, we offer finance for hard asset acquisition by businesses, always business critical investments. Our primary product is hire purchase. But we also do a lot of equity release, which goes by different names: sale HP back, refinance, this sort of thing. And we also offer finance lease. Our periods, these can be done over anything from 12 to 84 months, so 1 to 7 years, but very much it's suited around what a customer's looking for, often fixed to the lifetime of the asset or the contract that's going in. And we can come up with seasonal structures to suit that acquisition and VAT deferrals to support in the acquisition to help in the VAT. We do have also a wide variety of loans, invoice finance, mortgages, through a selection of partner funders. Next slide, please. So hire purchase. This is our sort of primary product. This is the majority of what customers prefer to use. It's very simple. It's very straightforward. It's very flexible, which gives customers a lot of choice. It enables you to basically spread the cost of that asset over the period that you choose. Like I said, this could be 1 to 7 years, and meaning that the asset gets to pay for its own finance, the revenue generated or the savings create for the asset over its life. You gain ownership at the end of it, and you would maintain and insure it exactly the same as you would do if you'd purchase this for cash. It's often more flexible than a loan, enabling you to borrow larger sums. We've done deals everything from £5 to £3 million 5,000 that is, sorry, to £3 million, so it's very, very flexible, using the asset as the security to support that investment. The regular payments are fixed, so this helps you budget, exactly what they're going to be, when they're going to be, and with them being fixed, the rate is fixed, which protects you from any further rate rises that we may enjoy going forward. Assuming the VAT can be reclaimed and that you are VAT registered, you normally can recover the VAT exactly as you would do with most normal purchases. Next slide, please. So equity release, like I say, this goes by various names: equity release, refinance, sell and HP back. This enables you to raise capital out of some of the assets you may already own within the business. These could either be owned outright, or even if they're on finance and you have got equity in it, this enables you to release the capital from those assets back into the business, which could be for any one of a number of different reasons. This could be for cash flow, this could be to purchase equipment or assets you wouldn't be easily able to finance. It could be to support a new contract or even a deposit for a further investment. We're seeing a lot at the moment, a lot of businesses are using it to consolidate existing finance, reducing the payments, spread the term out, and easing some of the pressure that some of the businesses are seeing today on their cash flow. Next slide, please. So finance lease, this is a traditional product. It used to be a lot more tax advantageous. Some businesses do prefer it because of the way it's treated, and usually accountants would advise to if it was suitable for you. It's similar to HP in that you spread the value of the asset over the period. You would be able to recover the VAT on the monthly payments instead of having to pay it up front, and you would spread the payments over the term of the contract or the life expectancy of the asset. At the end of the contract, you don't automatically gain title to that asset. You would either go into normally what would be a peppercorn or a secondary period asset, a secondary period rental, or you would sell the asset to terminate the agreement. Next slide, please. So here I've got a few of the contacts for our Midlands team. Obviously, you're welcome to reach out to me directly. You can go through our website, through LinkedIn, or you're welcome to contact any of the sales managers you see here. They will guide you through the application process. They will help you. They will advise what we need. If all of our products are supported by or can be supported by the RLS3 scheme, we are accredited by the BBB, and they will take you through that full process, doing everything to help you get that finance approved. Thank you very much for your time, and I will now pass you over to Martin.
Thanks very much, Chris. Good morning, everyone. My name is Martin Baker, and I head up the Midlands commercial sales team at Close Brothers. This morning, I'm going to talk to you about invoice finance and asset-based lending. If I can have the next slide, please, Tracy. Essentially, invoice discounting and invoice factoring are generically referred to as invoice finance. Essentially, we can raise up to 90% of the invoice value. Two main differences with the products: invoice discounting links into your accounts package, whereas full factoring is more related to, whereas full factoring is a credit control service. Basically, the main difference with these products depends on the sophistication in the business. If you have a credit control function, you're probably going to look at invoice discounting. If you don't have that, you're more likely to look at a credit control funded facility, which is factoring. Have the next slide, please. Our ideal system with invoice discounting is one of the best in the market. It essentially links in with the accounts package, enabling you to get real-time funding with over 285 accounts packages, Xero, Sage, etc. It creates the most important link between the accounts package and the software for you. The main issue, sorry, bear with me a second. The main issue you've got to consider with invoice discounting, bear with me. The main thing with invoice discounting to consider is the debt fundable? Is it factorable? The main thing we're looking at when we're talking about this is, are you providing a good? Are you providing a service? It's got to be easy to fund the book debt. Bear with me a second. Next slide, please, Tracy. One of the main things with your asset funding with invoice discounting is with a bad debt. If you get a bad debt, you need to make sure you are fully protected. We offer bad debt protection against each facility. This can give you 100% bad debt cover in the event of insolvency. It gives you credit management support. It makes sure you understand who you're dealing with. The biggest debtor, the biggest asset to a business is often the debtor, but you need to know who you're dealing with, who they are they going to pay you, and ultimately, if there is an insolvency event, you're getting cover. It provides peace of mind. It helps you trade with confidence, and ultimately, you will make sure if there is a bad debt that you're covered. Next slide, please, Tracy. As far as invoice discounting is concerned, it's not always the invoice discounting solution that works best for you. With regards to asset-based lending, you can have additional top-up facilities, essentially stock, plant and machinery, property, cash flow finance, and inventory. Essentially, we would look to advance 50% of the facilities in invoice discounting line and use the other asset classes to increase that funding. It's often used by businesses to fund mergers, acquisitions, or financial contingency and ongoing working capital. Next slide, please, Tracy. And finally, I just want to touch on the recovery loan scheme. We at Close Brothers are accredited as a RLS3 lender. The big upside for this is it can help businesses fund over and above where the lender is happy to fund. So on an invoice discounting line, we can provide a up to £2 million term loan. We can also top up the invoice discounting line to provide extra funding. For example, if we're at 70% prepayment on the facility, we could go to 80, 90, even further. It's government backed. There's a 70% guarantee with the British Business Bank, but the borrower remains liable for 100%. This is available until June 24, and it just helps us fund over and above where we as a lender are happy to fund. Thanks very much. I'll pass over now to Lewis.
Thank you very much, presenters. Really delighted to be on this call. My name is Lewis Stringer. I'm a senior manager in the UK network team, and I cover the East and South East Midlands. So before we reintroduce Daniel, Chris and Martin, I'm delighted to introduce Alison Bradley to the panel. Alison, welcome. Really great to have you on this morning's panel. Thank you for giving up your time. So in the first instance, can you please introduce yourself and Central Business Finance?
Morning, Lewis. Thank you for inviting me today to be on the panel. My name's Alison Bradley and I am co-founder of Central Business Finance. So we are finance brokers. We've been going just going into our 14th year, and we offer a full range of commercial finance products, and that's broadly split into 4 distinct areas. So cash flow, that's for expansion, growth. We might use it for management buyouts, buy-ins, acquisitions. Asset finance, Chris has just explained what that is, does what it says on the tin for assets, plants, machinery, equipment, vehicles. We also look at property finance, so bridging, development, buy-to-let portfolios, and grant funding. We're probably one of the only brokers that looks at grant funding for our clients as well. And very often we can look at those products in isolation, or we can use them as a package of finance. So it's our job as a broker to find the right and appropriate source of finance for our clients.
That's great. Thank you, Alison. I was going to ask you what a commercial finance broker actually is, but you started to talk about that a little bit. So maybe if you explain how you actually help a business to access finance and also work on the lender side as well.
Yes, of course. So A broker, it's our job to source finance for our clients, and in the main, these are SMEs. As a broker, we've got a thorough knowledge of the finance market. We're actually putting applications to lenders on a daily basis. We know which lenders have an appetite for what type of business, what rates they offer, what terms they offer, and it's our job as a broker to really understand. We operate in a consultative manner. We're solution driven for the client, so it's our job to understand what our clients need, what the business is about, what type of finance is going to be the best source of finance. If a client's looking for finance for stock, there's no point that they're going to turn around quickly. There's no point in us putting in a 5-year loan. They want a shorter term facility. So from the SME side, from the client side, obviously I'm going to say this because I'm a broker, but I think it's better that they do use a broker because they're going to get to the right and appropriate source of finance much quicker. We package and present the lending proposition that goes to the lender. So it's our job to sort of talk to the lender, tell the right story, present the case in the strongest fashion, point out any pitfalls and any advantages. From the lender's point of view, they get a packaged proposal, so they're getting a full, whether it's a business plan, cash flow forecast, application form, they get the whole pack presented in one go, rather than being in drips and drabs. And from the client's point of view, it saves them going round and round the market looking for finance. And very often we see businesses that have done that and they've sourced finance simply from the first page of Google, and it hasn't necessarily been the right type of finance for the business.
Okay, thanks, Alison. That's a really good description of the role of the broker. As part of this more formal panel for the webinar this morning, over the next 20-25 minutes, I'm going to ask you the same question a couple of times because I just want to get a view from other participants. But for the first time, I'm interested to know your view as a broker about what you perceive to be the current state of the lending market, both for the UK generally, but probably more specifically in terms of the Midlands. What's that lending market looking like at the moment, please?
Yeah, I mean, we don't really see any gaps in the lending market. There is finance available for, Daniel hit the nail on the head really, for viable businesses. And what does that mean? That's businesses that have, a relatively strong background, but have a story to tell, to go forward, their growth, what's their strategy for growth. So, we don't tend to see many gaps unless the business is not, has serious problems and is not viable. There seems to be a lot of finance out there. And, we started up in 2010 in the height of the economic downturn. And since then, it's fair to say that there's been an explosion in the alternative lending market. And I think that's what really complicates it for SMEs, for business owners, because there just is so much choice out there.
That's really interesting. Thank you, Alison. I'm going to ask you that question a bit later on in the panel, so beware. I'm also delighted to introduce Dan Williams to the panel. Dan, welcome. Also really great to have you on this morning's panel. Again, thank you for giving up your time. Can you please introduce yourself in the first instance and tell us a little bit about RivetWise and the business's journey over the last few years? Thank you, Dan.
Thank you, Lewis. Good morning, everyone. Thanks for your time today. So my name's Dan. So I'm the managing director of RivetWise. So RivetWise is proud to be a distributor of rivets and rivet nuts and associated tooling and repairs of those tools, supplying into large and small OEMs across the country into industries such as metal fabrications, automotive, aerospace, HVAC, etc., ranging from as large as clients such as JCB to Joe Bloggs Limited on an industrial estate, really, and everything in between. So the business has grown over the last few years, very well. We've went through a really exciting journey over that period in a challenging economic climate. We've started to develop our own brand of fasteners. And also won quite a prestigious premium partner agreement with Stanley Engineered Fastening to be their only premium supplier in the UK. So those are some great wins that we've experienced over that period. And I guess the next step really for us as part of our journey last year was we spotted an opportunity in the marketplace to further our own brand offering by releasing our own hand tools for battery and pneumatic to sell into our customer base. And also a suite of automation products where we can speed up a production line by up to 50%. We've already proven in the marketplace. And the challenge that we had is, okay, great, we've got these ideas, we've got the potential customers out there. How do we fund that growth and exploit the ideas that we have as a strategy over the next 5 years, really? So. The automation products, we've took into a number of clients recently, where a post-COVID era, they're looking to kind of get through the backlog of production demands and speed things up, or sadly in a challenging environment that we're in at the moment, potentially be more efficient and do more with less resource, which is where our product can come into its own as well. So we needed a way to navigate through this, which is where we're very grateful for the Alison and the team at Central Business Finance to help us through this through this problem, really, which is where we reached out to them. So the investment has funded a new ERP, 2 new websites, one for RivetWise and one for the own brand that we've released called RiveRight, which look fantastic. We've also had the product launch and everything that comes with that to get the maximum efficiency and effectiveness, from launching the brand. And we're very grateful for Alison and the team, really. We already had a CBILS loan, from COVID. As Alison said, there's a lot of options out there at the moment, and how do you navigate the best one for your business, combined with the challenging economic environment with inflation going everywhere and all the pressures that we're seeing in the news and everything at the moment. And as an SME, not being in touch with that on a day-to-day basis, it was incredibly insightful to have that support through that period, really. So that's a bit of a nutshell of our journey and how finance helped with being a part of our future growth as well.
That's really great, and great news as well, Dan, that you continue to grow, and many successes, and congratulations on the new website that you proudly sent to me last week. It looks absolutely fantastic, absolutely fantastic. Alison, if I can just very quickly come back to you, if you don't mind, is Dan and is RivetWise typical of the type of clients that approach you, and how aware is that typical customer of the options? Dan mentioned the particular difficulties of navigating through that minefield.
Yes, I think it's fair to say that RivetWise are the typical type of client for us. I've got to say that Dan is probably a bit exceptional in that when we ask for information, this is one of the problems we struggle with as a broker, and lenders do, is that we don't get the right information in a timely manner. But I've got to say that Dan has been brilliant all the way through. So whatever we've asked for, we've always got, which really helps when we're trying to source finance. And I think it's fair to say that RivetWise, it wasn't just a straightforward deal. There were certain nuances that we had to take into account. There was a shareholder to be bought out. Obviously, we needed finance for the expansion, but you really needed to understand those nuances to source the right provider of finance. We couldn't have just gone to any provider. So it's really getting in under the skin of the business and understanding that, and obviously getting the right information as well in a timely manner from Dan, which really helps.
Thanks, Alison. And I've got to ask you to respond to that, Dan. You're exceptional, apparently.
I was going to say, I'll pay you later for that one for sure. Yeah, obviously, I think my background is I'm an ACCA qualified accountant, so that obviously helps. From a spreadsheet perspective for sure. But even then, you know, we don't do this every day, and especially from a small business perspective, when you know, lending, you know, under conventional routes can obviously be a challenge. You know, we definitely needed that support through that process, you know, to get the best deal for us in a challenging economic time. So thank you for the kind words. So that's very kind. Yeah.
Thank you. I'll come back to both of you guys. Thank you very much for joining us today. If I can come next to Daniel. Daniel, welcome. Many thanks for your very informative presentation earlier. Found it really interesting. Before we dive into the challenges and solutions, I'm conscious we've got a phrase called working capital in the title of today's webinar. Can you please just clarify what you believe working capital to be, and how important, when you're looking at applications, effective working capital management is for a small business? Thank you.
Sure. Working capital is effectively the cash that the business is going to need on a day-to-day basis. And this ranges from, you know, purchasing office supplies to paying for marketing, networking events, stock, salaries, anything really that the client is looking for, that the client will need access to funding on a regular basis. When we are assessing applications, it is really important to understand the general cash flow and the working capital of the client, to make sure that the products and services that we offer are right. And I think it's really important to state that when you are a business and you're applying for funding, I think it's really important to make sure that you get the right type of funding at the right time. There are some providers who will just throw any type of finance to you, and it might seem like a great idea at the time to say, well, I need access to £50,000. Somebody's given me a loan, that should be sufficient. But actually, if you take out the wrong type of finance, it can really have a detrimental effect on the business and really strangle your business. And so what we do is, and what I would suggest is probably to speak to a broker. I think brokers know a lot more of all of the facilities out there in the market, and they can advise accordingly. And we actually work with Central Business Finance, so I can really back up their statements of packaging a deal. That's also really important for lenders, that when you do approach them, that deals are packaged in a certain way. It just makes our life a lot easier.
Thanks, Daniel. That's really helpful. Thank you. So we know smaller businesses often struggle to secure loans, especially during economic downturns. They may lack the necessary assets, financial track record, or even creditworthiness. And this constrains those options that you talked about earlier. Am I simplifying things too much here? Do most high street lenders seem to make decisions on the asset base of a business and lend against these assets? Is that true? Is that your perception as well?
So I think banks have their own credit policies and their own appetite to risk. I think that's really important. And sometimes organizations can apply for a loan and they are turned down by a bank. Doesn't necessarily mean that the business is not viable. It just means that that application doesn't meet their set criteria effectively. And in my presentation, when I was talking about the different lines of different funding options, each of those organizations are going to have different appetites to risk, sectors that they want to increase or decrease their exposure to. And so when we are talking about applying for funding, I think it's really important that clients go across as many different providers as possible, and they will notice that they get very different questions being asked and very different feedback. Unfortunately, you have to play the game. You can either play the game yourself and go across all the providers, or you can speak to a broker who already has those relationships set up in place. They have the knowledge, they have the experience, and when you approach them, they'll be able to signpost you to providers who they feel would welcome those type of applications.
Thanks, Dan. That's a really useful summary, and I love that slide of the various lenders and the logos as well. I'm going to come back to you a little bit later on, if I can do, and ask you a similar question to the Alison one in terms of how you're seeing things in the Midlands market. So if you can give that some thought in the meantime. Chris, can I come back to you next first? Thank you. Welcome. Another very informative presentation. Thank you so much for that. Can we spend a little bit of time just discussing that presentation and those finance options that are available from firms such as Simply Asset Finance? Maybe if you can just, in your own words, talk about hire purchase finance leasing and that asset equity release, which was not a term that was familiar to me.
No problem, thank you. Hire purchase, a lot of people are familiar with. It is everything from how people would use it to purchase a car, you know, for their own use, all the way through to obviously business assets, be those machines, trucks, whatever these may be. Ourselves, we work primarily only with business to business lending. So hire purchase is used to purchase business-based assets. These are going to be revenue-generating assets that will either make the company money or save them money. And the whole point being is how we back up that investment, that we can see behind, not just looking at the accounts and everything else, but we can see behind the rationale for the investment and use that to support that finance application. Hire purchase and finance lease are very similar in the fact they're both asset-backed, in the fact that they will use the value of that asset to help support the investment and enabling that business to access the finance. Like I touched on towards the end of my presentation, these can be backed up with the British Business Bank's recovery loan scheme, as was covered in some of the other presentations. This gives us additional security to help businesses access the finance that they need, and often on improved terms as required, but we work very closely with them to help them do that. But as I say, hire purchase, finance lease are very, very similar in many ways. It's more down to how they're treated in the accounts.
Thank you, Chris. So I guess if someone comes to you, how do you explain the advantages or disadvantages of each of those options so that the company picks the best option? Because I guess it will vary depending on where they're sitting at the moment.
It would do. I think usually the first question we would ask is, if somebody was saying they wanted a finance lease, the question would actually be why? Because usually there's a very specific need for a finance lease. I think it has been mentioned, certain types of finance sit very, very well with companies. And usually this would have been something that may have been advised by their accountant, or there'd be a very specific need why they would want to use finance lease. If there isn't that need, then usually it's hire purchase. Being honest, hire purchase, in my opinion, is a better product for the customer. They get title at the end of it. It's a very straightforward product, and it's a very flexible product. As I say, whilst the main framework is what it is, it's how we can structure within that framework to give the customers what they need, the cash flow requirements and everything else. So unless there is a very specific need for finance lease, it's nearly always going to be hire purchase, in my opinion.
Thanks, Chris. That's really helpful. And asset equity release?
Asset equity release is intrinsically hire purchase, exactly the same as if they were purchasing an asset. But the difference being is that this is an asset the customer would already own. So this could be something they've either owned or outright, they purchased for cash, or they purchased using finance originally and that finance is finished, or even it is on finance now, but there is equity within that asset and they want to release the equity, hence it being called equity release. Releasing that equity, very simply, we would take over the original finance, pay off the original finance, release the equity back to the customer effectively as a direct payment, and then they would continue paying hire purchase contract over the agreed duration. And as I say, it's also used exactly the same if customers wanted to restructure their finance. We're doing this a lot at the moment. We're seeing this very common, that obviously, payment terms are getting stretched, companies, businesses, cash flows are there's pressure on it. So taking some existing finance agreements, wrapping all of those up into one, stretching them out over a longer period, pulls down those customers' payments and makes it much more affordable and gives the customers the headroom that they need to be able to really thrive in the current marketplace. So intrinsically exactly the same as hire purchase, but the customer's the supplier.
Great. That's a really useful summary. Thank you for that, Chris. Martin, if I come to you next, again, thank you for your time. Yet another very informative presentation. So thank you for going through that with us. Maybe could I just ask you to differentiate between invoice discounting and invoice factoring in the first instance for us, please?
Yes, Lewis, certainly. I think invoice discounting is generally more suitable for businesses that have a finance function, that have an accounts package. Essentially, the most important thing for both products is that they're supplying a good or service with a clean invoice. As far as factoring is concerned, that's more where we will help a business do the credit control, we'll chase the debt, and ultimately it's more of a managed service, a bit more hands-on. It's disclosed to the client that they are supplying, so there's no confidentiality there. But really, it's all about leveraging cash tied up in invoicing to provide working capital to either pay suppliers earlier, to take advantage of supplier discounts or anything like that.
That's great. That's a really useful summary and differentiation there, Martin. So in your view, bearing in mind it will be different for different businesses, when's one more appropriate than the other for a business in your view?
Depends really on the sector they might be in. There may be some stigma in old-fashioned sectors, maybe manufacturing, engineer, about discounting your book debts. Equally, recruitment, haulage, people like that, they might be one-man bands. They haven't got the time to manage a sales ledger, they haven't got the time to do credit control. So it really depends on the sophistication in the business, whether they want a confidential facility or whether they're, what their key driver is really. It costs to have a credit controller. We would do that cheaper for a factoring facility. Equally, a lot of people want to run their own finance team. So in that case, invoice discounting works. But our system, the ideal system, links in to the sales ledger. If you've got a Xero, a Sage, or a multitude of well-known packages. So a lot of clients that may use factoring with another provider can actually use invoice discounting with ourselves because of that technology.
Thanks, Martin. That's really helpful as well. And just very briefly, you mentioned asset-based lending alongside those options.
Yes.
Why? Why is that important?
Yeah, good. The whole thing with invoice discounting leading into asset-based lending is the security of the lender is the asset, i.e. the debtors, the stock, the plant and machinery, the property. It's very important for potential borrowers to understand that because the lender's secured on that, there is less personal liability needed for these facilities. But asset-based lending, essentially, not to be confused with asset finance, because that's purely funding against plant and machinery on the asset. Essentially, it just allows for growth. It allows to sweat the balance sheet, to put different asset classes under a different funding structure, but it would usually be invoice discounting led. The debtor has to lead the facility. So roughly 50% would need to be invoice discounting led. And then the rest of the facility could be a mix of a revolving stock facility, a P&M loan, and then obviously cash flow for the larger businesses. But it's very useful for larger, well-established businesses, probably over 20 million turnover, that have potential merger acquisition opportunities or sale events to leverage every asset on the balance sheet, keep it all under one roof, and provide that liquidity and working capital.
Thank you, Martin. That's, again, a very useful summary for me. Just to make the audience aware that you do have the ability to ask questions at the end of the formal panel, so please feel free to add your questions in the Q&A section on your screen. Alison, I promised to come back to you on the lending market, so I'm doing that now. Clearly, you started to talk about 10 years ago, the lovingly called credit crunch. One of the reasons for the bank and one of our key objectives is to create those greater options. So just summarise how that marketplace has changed over that last 10 years in terms of the alternative lenders and the finance options that are available to businesses now.
Yeah, well, I think sort of, back in 2010, it was a perfect storm of situation, wasn't it? Very low interest rates, savers had got nowhere to put their money. The banks had kind of shut the doors and become very risk averse. And, we saw probably funding circles, probably the first one. I think when we started, we'd got 4 members of staff and funding circle had got 10. I think they've got thousands now. So, yeah, I mean, it created, and it's a funding circle will tell you they're not a lender, they are a tech-driven business. So I think that's what's happened in the market over the last 13 years, things have become much more tech driven. So there's a lot of platforms now. I'll give you a real life case. I've got a client at the moment that has been to a lending platform and has got 2 offers of finance, but he needs a 5-year facility, and he has been offered 2 very, very short-term facilities at very high interest rates, monthly interest rates, which just aren't suitable for him at all. So he needs, he needs a broker to sort of get in under the skin of his business, look at his forecasts. It's a seasonal based business, so that's probably why he's been turned down for sort of longer term funding. But we have got lenders that will look at that. And, lenders like First Enterprise are, a very important part of our toolkit as a broker, because they will, listen to the background, they'll look at a forecast to see what opportunities a business does have. So I think, in the marketplace, we need all of these types of finance, but it's very, very nuanced, and you really do have to understand what type of finance is right for your business.
Okay. Thanks, Alison. That's a great summary. I couldn't have put it better myself. So thank you for that. Dan, I'm going to come back to you next. We often hear that smaller businesses in the region are reticent about borrowing money, particularly in the current economic climate. Look, there's risks associated with borrowing money, isn't there? There's got to be some sleepless nights. Did you have any concerns? Did RivetWise have any concerns? And what were the risks to you, and why did you take the plunge?
Absolutely. I think especially in a period of uncertainty, with borrowing costs increasing, it's a natural thought process to maybe hold off, and wait for that better moment, etc. I think for myself, maybe my background is contributable to that. It's more about, what's the cost benefit analysis of staying or pressing the button, really. Some of the margins that we can make on the initiatives that we've developed, outweigh the cost of the investment, really. And that was kind of the trigger point to be able to press go ahead with the growth plans that we had, when making the loan investment a few months ago, really. So I think always, looking at the data, what would this investment unlock, from a sales perspective, will that generate more sales? Will it increase profitability at the bottom line? And ultimately, are you going to be better off, at the end of it, from a cash flow perspective as well, really? And when we did that analysis, and obviously, submitting what Alison says is the over detailed reports in our example to the lenders, they obviously agreed as well, and it's been very successful. But that would be my recommendation to anyone considering finance, really, is it's got to be right for you and your business, and it can't be a short-term thing when you're going to be paying for it over the next 5 years in our example.
Some great messages, Dan, and just hold on to that exceptional phrase right at the start. So again, it's great messages, and it's all important to do that financial management side of things as well, which is much to your credit. Thank you for that. Daniel, Chris, Martin, I'm going to come to each of you in turn, if you don't mind. For your respective finance options that you're involved with, what does a good application look like? What are the sort of things that you're looking for in a good application? Maybe if I can come to you first, Daniel, please.
So I would say one of the most important things is to have a very engaging client. I think that's always a very good starting point. I think clients should understand that when we are going up to our underwriters and coming back, it's almost inevitable that there are going to be some further questions that need clarification on, and having that good engagement with the client is always really important. Second point is cash flow forecasts, sales assumptions. We need to understand exactly how the organization makes money. Where's the money coming in? Where's the money going out? The client might know that like the back of their hand, but we don't. So treat us accordingly. And just try and present the organization's cash flow as easily as possible. It really helps us assess the affordability of any facilities that we're providing.
Thanks, Daniel. And Chris, what makes a good application for you?
I think for ourselves, it's very much about the client being very open with us. Our salespeople will work very closely with the client. They will come out and see them, sit down, understand exactly what they're doing. And if there's bad news in the background, if there's something's happened, if they've had issues, then the best thing we could do is very much address those at the front end. Very much underwriters want to know the full story. I would always explain it like doing a jigsaw. So, we don't always need a cash flow forecast or budgets or whatever, but sometimes we do like bank statements. They really do show the true trading position of a business. Very easy to get. We use the open banking system as well, which is fantastic, enabling clients to send us information. It's just a snapshot information very quickly and easily. So customers that are very open, give us the information. These can be very simple, last set of accounts, often bank statements. If they keep some management accounts as well, then even better, And then the salespeople will work very closely with the client. If we needed something like cash flow forecasts or budgets, then we would work with them to help them get all that together, to get that presented to the underwriters.
Thanks, Chris. And Martin, anything to add to that?
Yeah, similar to Chris, really. Obviously, understanding the business and meeting face-to-face is key for us. Initially, prior to that, it would help to get a suite of information, debtors, creditor summaries, management accounts, forecasts if they're available, and year-end accounts to help us understand what the business looks like. But with invoice finance, it isn't obviously suitable for every single business. So what makes a good application for us is obviously, as we refer, a discountable or a factorable type business, i.e., someone that is supplying goods and services that we know is essentially discountable, because that's key. Once we know that, similar to Chris, we want to understand the good, the bad, and the ugly, if that is the case, and get to really know what issues there are, what cash is needed, what other lending they have in place that could either be replaced or added to with our facilities.
Thank you, Martin. And just very briefly from each of you, if I may do, are there particular sectors at the moment in the Midlands that you're seeing lots of applications from? And dare I ask, are there some sectors that you're having difficulties with at the moment? Maybe if I come to you first, Martin.
Yeah, I think sector-wide, it's a good spread. Obviously, with invoice discount, we can fund a host of sectors, but manufacturing, engineering, wholesale, distribution, haulage are all sort of key sectors for us. And engineering, manufacturing are businesses that have felt the brunt of cost rises over the last few years, supply chain issues, all that stuff. So we may see requests to replace other funders with more liquidity, or rejig or restructure. But it's a broad range, really. We are not sector specific. We fund supply to retail. We fund supply to construction. Construction is a challenging sector, nothing to do with the sector itself, but more to do with the billing profile and the contractual obligations. We really need to have an order, a product or service supplied with one invoice, straightforward sort of proof of debt, and a very clean receivable, which is why we fund 70, 80, 90%. So anything that's maybe interim stage billing or projecty type stuff is difficult for most traditional discounters.
Thanks, Martin. Chris, anything to add to that in terms of sectors at the moment?
And we're finding most sectors are reasonably busy. Construction's always seems to be one of the first to take the brunt of any sort of downturn. We're seeing a lot of house building is quieting down a bit, new projects and things like that. The construction industry, like I say, traditionally slows down the first and picks up the first. But fortunately, it's also a very capital intensive industry, so it has that sort of usually that bit of fat on the back to fall back on and release equity to tide them through the bad times. Like has been said, I think by a few of the presenters, again, we cover a variety of industries. So manufacturing, as we said, has suffered the issues with the power and everything else. But, we're beginning to see the price rises they've been able to pass on. and hopefully they're beginning to sort of turn the corner. But we're working very closely with all our clients to help them through it. You know, I think in general, the world is still very busy out there. You know, people just need to be comfortable where they're at and understand, you know, their marketplace at that time.
Thanks, Chris. And finally, Daniel, are there particular sectors that you're experiencing growth with, or not so much growth?
Not necessarily a sector that sort of jumps up for our attention, really. But one of the things that I would like to say is, in terms of the new applicants that we get a constant flow of entrepreneurs that are looking to borrow to start up their own business. And you would think in, for example, the cost of living crisis that this may decline, but actually we've seen the complete opposite. We've seen a lot more people starting up their own businesses, maybe even as a side hustle to start off with. And then as that grows, then they can move away from full-time employment. But overall, quite positive.
That's great. Thanks, Daniel. And it's great to see that there's still that entrepreneurial spirit going on despite everything. Alison, if I can come quickly back to you. So we've just heard from 3 lenders and funding providers about what they like to see in a good application. What would make your life easier as a broker, both from a client perspective and maybe from a lender's perspective? What's good practice in terms of an application?
Right, where do you want to start? No, seriously. From a client's perspective, you know, there's a standard sort of shopping list of information that we would request, and just to be open, really. You know, we want to help. We want to, you know, we want to raise the finance for you. We want to help your business. So, you know, if we've asked, has your business got any other loans, and you've completed a form for us and put nothing down, but then we can see on the bank statements that you have got other loans. Just be open and clear in the first place, because it just saves everybody time. And from you know, from the lender's perspective as well, you know, alternative lenders, Daniel, Chris, Martin, they want to lend. You know, we want to help businesses. So you know, so just be open. And from our perspective with lenders, you know, we do really try and understand what a lender requires, and every lender has got different requirements. Some might want 3 months bank statements, some might want 6, some might want a business plan, some might not, you know, so every lender has got different requirements. So we understand that, and we know that. And I think it's just, you know, the speed in which lenders can come back to us. That's what we're really concerned with. Yeah.
Thanks, Alison. That's really good. Thank you for that. Dan, if I can call you back to the panel. Today's webinar will have an audience of small businesses. So if they're currently considering their finance options, what lessons have you learned over the last few years, good and bad, from your own experience? So what advice and guidance would you want to impart for those small businesses?
Yeah, sure. I was not to be detrimental to Alison and Central Business Finance, but I was actually quite sceptical about using a broker to begin with. You know, considering, you know, you can look online, you can apply yourself, and I very quickly realised that it's a minefield. And sometimes the best options you need to seek some help on, you know, and you get a much better deal, you know, regardless of the fee, and it's definitely worth that investment. So I think seeking advice sometimes is the right thing to do. I also think that, you know, not to discourage investment, but you have to make sure that the numbers stack up firstly, you know, and not just invest for investment's sake, you know, to compound a problem later down the line as well. So sometimes not investing is the right thing to do as well. So we've had, you know, a proof of concept with, you know, in the marketplace for 2 years before we pressed the go button. And I think it was the right thing to do, to be cautious and build that business case firstly before going ahead and doing the investment and obviously the facility, you know, drawdown, etc. So I think that would be the key takeaways that I've had from the experience to this point with our organisation.
Thanks, Dan. That's really good advice and guidance. Thank you for that. Martin, Chris, we all know that since the COVID-19 pandemic, we've experienced a number of other economic issues, haven't we? You know, recruiting right skills, supply chain difficulties, rising energy costs, other costs, inflationary pressures, and more recently, increasing of interest rates as a result of that. I'm sure I've missed something, but not wanting to be pessimistic, what do you think the implications have been for businesses that have been working with you about their confidence about investing and growing in the marketplace? Maybe if I come to you first, Martin.
Yeah, there's a lot of issues gone on there, isn't there, Lewis? And obviously, we've got the problems in the Middle East at the moment, which could continue to give us more uncertainty. But we, as lenders and our SMEs, battle on. I think the overriding effect of all these challenges has been a squeeze on liquidity for our clients and our prospects. Obviously, it's resulted in businesses having to take on more debt, and they're trying to understand if they can service that debt. There's also issues with HMRC. Time to pay arrangements are more prevalent. So really, it's that liquidity squeeze, I think, is causing the main issue for businesses, and then understanding from there how they go on to invest. Obviously, plant and machinery, HP is another debt, but it's fundamental to the business growth to invest. So more importantly, I think it comes down to for management in a business and a lender to have strong financial controls and good quality financial information right the way up from management accounts to forecasts to short-term cash flow forecasts. So a lender can buy into a story, buy into an investment play, despite the fact there's been challenges and continue to do so. As we're secured lenders, the security helps us fund. Obviously, we have to have one eye on viability, as should any management team in a business.
That's great. Thank you, Martin. Anything to add to that, Chris?
No, I mean, I would echo everything that Nina said. Obviously, liquidity is important. I think the big thing at the moment I see is confidence. We have a lot of customers that have very good, very capable businesses with good, prospects going forward, very viable and everything else. It's having that confidence to invest. The uncertainty around interest rates, obviously, right the way out to the political situations and, as echoed, the issues in the Middle East, etc. It does impact on, businesses' confidence, but obviously they need to look at what they can do to stabilize their business and grow that business in a sustainable way, working with the funders to get what they need and grow going forwards.
Thanks, Chris. Thanks, Martin. Alison, Daniel, if I come back to you as well, where do you think that all leaves us? I promised to come back on the question of, what's the finance market like in the Midlands at the moment? Are you seeing any trends? And are you confident? And it seems like it, that there is that finance for businesses that want to grow and invest in the Midlands. Alison.
Yeah. I mean, as I said before, I think there is a good range of finance options out there for businesses. Obviously, we've seen rates increase because the base rate has increased. So, we can't do anything about that, but it is what it is. I think in terms of trends, yes, we're definitely seeing an increase in short-term lenders during the market. So we've got, the likes of Plata, Multify, organisations like that have, that are new to the market. So I think that is definitely a trend. But as I said before, as a broker, and I agree with Dan, actually, I don't actually like the word broker. I like to think that we act in more of a consultative manner. But no, I don't see that there is a shortage of finance in the market.
That's great.
It's accessing the right type of finance. That's the issue.
Thanks, Alison. That's really helpful. And Daniel, if I come to you, is that your view? Do you see any gaps in the marketplace from your applicants?
Well, just to touch on a quick point that Alison said earlier on, after the financial crisis, so 2007, 2008, I think there was a lack of alternative lenders in the market. Fast forward to now, 2023, and we're in the complete opposite situation where, as Dan was actually also saying, you can go onto Google and you can Google business loans, and I guess that's a starting point. But very quickly, you'll become inundated with the amount of different providers out there in the market. From a first enterprise point of view, we see a lot of seasonality. So over the summer period, applications tend to drop off as people go away on holiday. But when people come back, the amount of applications that we receive definitely ramps up. From a startup loan point of view, tends to go a little bit quiet around December, and then January just absolutely explodes while everyone makes their New Year's resolutions to start up their own business.
Thank you, Daniel. You mentioned the Christmas word. I thought we'd get through the webinar without mentioning the Christmas word, so thank you for that. Just a reminder to the audience that there is the opportunity after the formal panel ends for questions and answers which we put to the panelists, because we're coming to the end of our formal panel. And actually, it'd be unfair of me not to come back to Dan for the last word. Dan, I'm coming back to you for the last word. What does the future hold for RivetWise, please? What's you going to do next?
Well, I think take stock of what we've already done in the last few months. It all seems to have happened at once, you know, through one reason or another. We've had a new website, new ERP, launched a tool brand, got them stocked on the shelf, signed some distribution agreements with our brand. So it's been a bit of a whirlwind of a few months, and definitely looking forward to that Christmas break, you know, that you said for sure. But the next thing is just building on that momentum, really, you know, and winning some of these opportunities that the refinancing has unlocked, and growing the business, you know, as a bit of a platform, you know, that it's provided, really. That could be through future funding as well. You know, we've got a good problem at the moment at RivetWise, where you kind of need that working capital to be able to fund such large opportunities which the investment has generated. You know, where you obviously got some, you know, in a lot of examples, you've got to buy a lot of this equipment up front, and then you've got the cycle of of collecting the debts, you know, afterwards, and realizing the return on investment. So it's a new problem that we have now, all for the better, which we're looking forward to navigating in 2024 for sure.
And that was going to be my final question, Dan, if you don't mind. Any reservations about taking that finance if you need it?
I'm very pragmatic, really. You know, if the numbers don't add up, then you don't do it. But obviously, you know, if you've got such great margins with our new products, and we can really, you know, take advantage of some excellent opportunities, then it adds up to do it, really. If you've got that covering purchase order from the potential clients, then it's a fairly safe bet, in my opinion. So we'll navigate it cautiously, but the activity that we've seen just in the last 2 weeks since we've launched our brand and started to sell has really accelerated the company to something quite exciting that I look forward to seeing through over the next few years for sure.
Wish you every success, Dan. And before I pass over to Tracy for the Q&A, I just want to add my personal thanks to our great panelists this morning. So Alison, Dan, Chris, Martin and Daniel, thank you so much for your time. Over to you, Tracy.
Thanks, Lewis. And yeah, thank you very much for the panel for joining us today. So we do have a few questions from our attendees that I'm going to just start running through with the panel. So the first question, what is the typical arrangement fee on invoice discounting? So I don't know who perhaps would like to pick that one up.
Yeah, hi there. Hi, Tracy. I can pick that one up. When we're talking about an arrangement fee, I think that may mean service charge potentially. But if I explain the costing of an IF or invoice discount facility, it probably helps. Essentially, you pay a service charge, which is a percentage of notified turnover. That is the additional cost above a sort of borrowing charge for drawing down on funds, and it's tailored to the turnover of a business. So, for example, if you turned over £1 million, it might be 1%, for example. But if you turned over £10 million, it could be 0.2%. But we price each facility in isolation. Arrangement fees for transacting the deal are minimal. It's that service fee that potential clients need to understand is the additional cost to them.
That's brilliant. Thank you, Martin. And Daniel, I think the next question is probably going to be for yourself. So do any of the presenters' companies provide finance for a startup in the pre-sales stage?
Yes, absolutely. So Startup Loans Company, and we are a delivery partner on behalf of the Startup Loans Company. We absolutely look at applications that are pre-sales. I think it's quite important to emphasize that from our point of view, we would need to understand your business plan quite well. Effectively, what we need to do is prove affordability of any type of borrowing that you are taking out. So absolutely, we would actually welcome those type of applications.
That's great. Thanks, Daniel. So my next question, will invoice factoring work with overseas debtors? So I don't know who'd like to pick that one.
Looks like that's probably back to me. Yeah, it certainly would. Obviously, export sales are fine to be discounted against. It's a higher risk, so we'd always recommend if there's any more than 5 or 10% of export sales, they're either credit insured or we could offer bad debt protection. It depends on the territories. You know, the EU, OECD nations are fine. If you're going further afield into what we class as approved and unapproved territories, it might be more challenging, but no issue with funding export debt or invoicing at all.
That's great. Thanks, Martin. Thank you for that. And the next question then, how the healthcare industry is seen by lenders, and is it perhaps perceived as a risk, or is there associated risks in regards to the healthcare industry? Don't know who'd like to pick that one up.
I don't mind picking that up, Tracy. From a First Enterprise point of view, I think every type of industry has risks. You'll never get away from that. It just depends on the lender's appetite and how they address those risks. I think in terms of applying for funding, underwriters understand that there are going to be risks in every proposition. What's important is to show how you can mitigate those risks. And if you can't mitigate them, to be as open as possible and just say, look, this is the risk that we have, and we have no plans in place at the moment, or we're unable to mitigate that risk. But I think just being open and transparent with underwriters is quite important.
Thanks, Daniel. Okay, we've just got a couple more questions in the chat. If you do have a question, please pop it into the inbox and we can send it over to the panel. So in the next question, we found a massive hole in the market which was previously filled by CBILS, and businesses are now struggling with asset finance for any assets outside of the mainstream. So is there anybody that could perhaps explore a little bit more on that one?
Oh, I'll pick that up with this mentioning asset finance. I'm obviously unsure exactly what the question is referring to as by the mainstream as such, but I mean there is still the recovery loan scheme there provided by the BBB to support asset finance as CBILS did early on. So this is useful if the asset is maybe sometimes a little bit more difficult in relation to its value and such like, or the application itself needs that additional support. So I don't think there is a hole in the asset finance in the asset finance market. Ourselves are very willing and able to looking to lend. But obviously it's difficult to understand what they mean exactly by the mainstream, whether that's mainstream assets or funders.
Thanks, Chris. And the next question that we've got, we're seeing a number of alternative lenders getting into trouble and running out of funding, with some even closing. What advice do you give businesses to account for this? So don't know who on the panel would like to perhaps pick that one up. Chris?
Shall I come back in? I mean, obviously, I think we'd probably be classified as an alternative lender. I mean, with asset finance, it's a structured agreement. So hopefully it would never happen, and we're well supported by BBB as one of our finance providers. But should the unexpected happen and we run out of money or even close, it would have no impact on a customer's finance agreement with ourselves. That would continue to run the term. As long as that customer met their terms, then that wouldn't be withdrawn. It would have no impact on the actual client.
No, thanks, Chris. That's great. Thank you. I've just got a few more questions as well. So typically why are the terms and conditions, particularly the pricing of any debt for an alternative lender, notably different from those on the high street lenders? Pricing is often much higher. Does anybody want to perhaps look at that one for me?
I'll take that. Pricing will be higher, absolutely. And the main reason for this is because of risk. So high street banks offer the best rates, but they typically pick and choose the type of businesses that they lend to. And those businesses that they lend to typically are the ones that pose the lowest financial risk. And as you go down in terms of one of the slides that I had, as you go down to the other providers, the appetite to lend becomes greater. And with that, unfortunately, comes with higher interest rates. On the topic of rates, I would say that interest rates on borrowing is just one aspect of the overall deal. And I would really implore people to pay close attention to the covenant structure of any type of facilities, because those can really strangle your business if you sign up to an offer that doesn't offer flexible covenants. So interest rates will always be higher than a high street bank, essentially because of financial risk.
That's great. Thank you, Daniel. And we've focused quite a bit today on debts and lending today rather than equity investment. Why would a business choose debt rather than perhaps equity to finance their growth? Does somebody on the panel want to pick that one up?
Hi, Tracy. I can pick that up if you like.
Thanks, Martin. Yeah, that'd be great.
Yeah, obviously, debt funding is loans, etc., that the business can apply for, which keep the shareholders in control. Obviously, giving away equity will lose some control in a business. So it's that toss-up really for management to understand whether they want to give away equity or not. Often the two can sit together. You know, you might use debt to fund your working capital, either your assets, your invoices, and other things, and equity might be provided by, you know, a PE house or VC or an investor to fund the strategic growth, marketing, the sort of fluffier, not hard asset side of things. So it's a blend, really. It's about control. It's about how attractive your business might be to an investor or private equity, and then equally, you know, what your end game is, what your exit might be, because owning 100% obviously of a business, you get essentially 100% of the profits.
Thanks for that, Martin. Just whilst I've got you, Martin, what would you say? We've talked today quite a bit about the advantages of perhaps taking out a loan or taking out that finance. But dare I ask, what would you say are the disadvantages and perhaps the risks of that?
Yeah, the difficulty with taking out a loan, I suppose, is you have to service it. You have to pay it back. There is, you know, ultimately your cash flow when you take that loan out might be in one position. You get some bumps in the road. Things can change. So it's having certainty that if you're taking out a committed fixed term loan, that you can make the payments on it, really. Whereas obviously equity on the other side, following on from what we just said, you know, there isn't a repayment with that side of things. So it's that balance.
That's brilliant. Thank you. And I'm just going to come on to my last question that we've got from the audience. So do you feel it's beneficial for small businesses and entrepreneurs to have some level of external support from a business advisor or fractional FD to help the business owner as a mentor or support? And do lenders view it positively for a client who has some level of advisory support network in place? So I don't know who perhaps would like to pick that one up.
Yeah, I can do that one if you like, Tracy, from an SME perspective. So we actually do use a business coach. We use a company called Action Coach for someone who's actually used to be the vice president of one of our premium distributors, premium manufacturers, actually, and he's been very insightful and helps us through our business journey. For, you know, for having someone on your shoulder for a minimal fee to guide you through that growth process that's kind of been there and done it, I find extremely valuable. You know, especially through the challenging periods that you know that we're going through at the moment in the economic climate, for sure. I also think, you know, having that network, you know, as alluded to in terms of financing options and being able to be there on hand, you know, if you need assistance, if things aren't going the way that you want it to in some circumstances, Or on the other hand, if you want to navigate an idea or a growth plan, but not quite sure how to go about the right way of executing it, there might be a number of options. I think it's really, really useful to have that to hand for sure, and I would definitely recommend it from an SME's perspective of what I've experienced at RivetWise.
Thank you, Dan. That's great. Thank you. Does anybody from the panel want to add any comments from the lender's perspective on that? No. Okay, well, we've come to the end of the Q&A session now, so I'd just like to hand back over to Warren for him to just summarise the session and close the event. So Warren, if you'd like to join me, and I can hand over to you.
Thanks, Tracy. It's been a pleasure to be here with you all today to delve into further detail on finance options for growth, such as cash flow, lending, asset finance, and invoice finance. The British Business Bank initiated Business Finance Week for this very reason of bringing us all here today to help smaller businesses like yours find out more about the ways finance can help your business to grow. Hearing from our speakers has helped share information on cash flow lending, asset finance, and invoice finance, and we hope this will help you on your journey. I want to take this opportunity to thank our speakers today, Daniel from First Enterprise Loans, who spoke about their offer and the journey a small business would go through and not giving up when applying for a loan and you get a no. And it was interesting to hear Daniel's views about seeing a lot of interest in people looking to start a business at the moment. Chris from Simply Asset Finance talked about what asset finance is and aspects like asset equity release, where a business can release cash from an existing asset that they own. Martin from Close Brothers spoke about invoice finance and how this can help a business get paid quicker from their invoices. And Daniel, Chris, and Martin all spoke about what they look for from business applications. They all said they look for an open and engaging client who has information on cash flow forecasts, accounts, bank statements, and this all helps the lender to understand what is going on in the business. Thanks also to Alison from Central Business Finance, who shared how a broker can help their clients source finance from the market. And as Alison said, there's a lot of choice out there in the SME lending market at the moment. Alison, like other brokers, want to help, and similar to the lenders, said there will be a standard set of questions and information they will want to see from small businesses. So please be open, please be prepared. And of course, thanks to Dan from RivetWise Limited, a small business specializing in tooling and distributing products like rivets and fasteners, who shared their journey securing finance and how it has helped the business to grow. And Dan's lessons that he shared was it was not easy trying to find the solution yourself via online means. So seeking advice was the right thing for them to do. And also to look at the numbers. Do they stack up for your investment? So build the business case first. And of course, my thanks especially to Tracy and Lewis, who pulled everything together and did an absolute marvelous job hosting today's session. Everyone's contributions have helped to make Business Finance Week a reality. Business Finance Week continues until the end of this week, and I hope you'll be joining us for some of the other activities, especially the webinars taking place each day. You can still sign up on our webpage and come along. The good news is that we'll be making webinar recordings available in the coming days, so you can catch up on them too. We look forward to hearing how your business journey evolves, so please do stay in touch. And this brings us to the end of our webinar, Alternative Funding for the Midlands, Unlocking Your Working Capital. Thank you very much for being here with us today. Have a great day, everybody. Bye-bye.